RIN TV coverage of the 2015 European Insurance Forum is brought to you by the Dublin International Insurance and Management Association. Solvency II and regulation in general were major topics here at the European Insurance Forum in Dublin. We spoke with Gillard, a financial services partner at Deloitte, about the implementation of Solvency II and whether he saw any new regulations affecting insurers in the near future.
We're really entering into the final phase of Solvency II now in terms of the preparatory phase. And this is really the key period where people are really getting away from all of the preparations and getting into that final phase of saying, can we actually deliver? I think what we're seeing is a lot of the challenges now are around that piece of delivery. So particularly on the Pillar 3 side, the quantitative reporting, how do we actually get that over the line and make it real? But also then on some of the governance side, actually how are we making that part of our business as usual and actually proving the use test of things like ORSA and your capital model as part of that. So we're entering that final sort of lap or hurdle in terms of preparation. But I think the important thing to remember as part of this is that really actual implementation, those first few years are really still a transitional piece, that this is where you're going to get the real feedback from regulators, where you're still going to be tweaking, you're still going to be trying to ensure that you've done things properly. So when people think, well, as soon as I get to 31 December or 1 January, I'm there, really people should be thinking about this as still a project that's going to be in a project phase for a period longer as they actually bed everything down and get it into business as usual. I think this is one of the big challenges at the moment, is where are the regulators at and the challenges that that's going to present. Pretty much all of the member states are still in the phase of trying to put the legislation in place. So despite only being 6 months away from the end of the preparatory phase, we still don't have final legislation. We still have a lot of implementing measures to come out. We still have a lot of guidance to be put in place. So the big challenge with the regulators is how ready are they to actually regulate. And I think that's going to be very important in terms of how we see then regulators actually regulate during that first couple of years, because there has to be an expectation of some degree of tolerance and working with the industry to actually work together to implement this together, and not a big bang on 1 January where effectively a not completely developed regulatory framework is being imposed on people. There's a big debate going on at the moment around global regulatory standards and where does that fit, because obviously as we move towards Solvency II in Europe, there's that question of, well, we didn't get group supervision in properly as part of Solvency II. We're working with this imperfect world of colleges of supervisors that don't necessarily operate under any real regulatory footing. And then on the flip side, we've got the globally systemic insurance debate going on around how are we going to regulate these larger groups, and whether we should be regulating them, and what sort of standards are we going to use for those. So we're going to get these global capital standards coming out, and how much alignment will there be between individual regulatory countries and those global standards. I do think that the one common glue between all of these is the concept of the ORSA, and that ORSA concept is probably going to be the piece that helps us ensure that any global process is aligning or at least knitting in with local processes, because we're seeing Solvency II has ORSA, but we're seeing Australian regulator using ORSA, Bermuda using ORSA, US using ORSA, Canada using ORSA. So I do think we're going to have this continued push towards global standards. I do think ORSA will be part of the glue that knits that together. There's been a lot of debate around the BEPS project and effectively how that's going to transform domiciles of entities and how multinationals organise their affairs from a tax perspective. For the insurance industry, it's an interesting area, because while most insurance activity cross-border within groups is seen as really transferring risk, it is causing challenges to the traditional captive models and also some of the key structures used in terms of, for example, in an Irish context, Dublin Bermuda structures where you'd have significant quota shares going back, and looking at that, and also the financing of operations and the use of tax structures to enhance your tax planning. So overall, I see BEPS as having an impact, but not a fundamental impact on the structuring of insurance groups and insurance entities. But over time, I think what we will see is a greater alignment of decisions between not just tax, but risk management decisions and regulatory decisions around where you choose domicile. So overall, I think we're seeing tax falling down the list of priorities when people look at structuring and domicile, and other things moving up the list in terms of capital management, risk management, as part of insurance group decisions. I suppose as we reach the implementation of Solvency II, the question on most people's lips is what's next in terms of regulatory change, or where's the next wave of regulation? I think it's fair to say that from a prudential point of view, the regulations coming out of Solvency II, we're going to see a relatively long period of still change happening as they bed down. But clearly the big area where we see new regulation, and probably the biggest next challenge for insurers, is going to be around conduct risk and conduct regulation. So really we're seeing that shift away from the prudential, how are we protecting the solvency and capital of the industry, to the consumer and the customer, and how are we protecting the consumer and the customer. So we're looking at all of those different developments around conduct risk, around retail products and how they're packaged, and generally around consumers and the protection of consumers. And I think that's going to be the next wave. We've already seen certain jurisdictions like the UK, with the bifurcation of the PRA and the FCA, focus very much on that. And for example, within other European countries like Ireland, we've had the regulators come out quite strongly to talk about conduct risk as being a key area of focus going forward, and that we'll see more resources being put into that area, really as we step away from ensuring that the financial institutions themselves are stable, to looking at how are they interacting with the consumers and making sure consumers are appropriately protected.
For more of our coverage of the 2015 European Insurance Forum, visit the DEMA website or the special 2015 EIF channel in the RIN TV On Demand library.